You have probably seen it in the news or on your feed that the repo rate has been cut by the RBI. Sounds technical, right? But what does that actually mean to a common man? Will you be paying lesser interest rates? Will your bank charge you lower EMIs? Or should you be doing something about it? Hi, I'm Mohit Tolani and I'll help you answer all these questions. Let's start from the basics. Say you want to take a loan, a home loan or a car loan. Now you have two options for this. Either you can apply the loan from a bank or from NBFC, that is a non-banking financial company. Say for example, both of them are offering the loan at 9% interest rates. Now, how is the interest rate decided? It has a very specific structure to it. In case of the bank, it has two parts. First part is repo rate, that is decided by the RBI. Second part is spread, that is charged by the bank. Now what is repo rate? Repo rate is the rate at which banks borrow money from the RBI. In case the repo rate goes up, the bank will have to pay more to borrow the funds from RBI. And this way, the banks charge this extra cost to you and me in the form of charging higher interest rates. But when the repo rate comes down, like it just did, banks are getting money cheaper from the RBI. In this case, if the banks want to pass this benefit to the customers, they can even do so by cutting down the interest rates. So, in simple terms, repo rate cuts can mean cheaper loans and lower EMIs, but only if your loan is linked with repo rate. But there is a catch, the spread. Even with the reduced repo rate, the actual loan rate depends on the spread that the bank charges. The spread is different from bank to bank. It depends on the things like your credit score, your income, your loan type, and bank's own policies. So, two people applying the home loan at the same time from two different banks might still be paying different interest rates, even if the repo rate is same. You can consider spread as bank's profit margin. That's how they are covering their cost and risk. Now, what about NBFCs? NBFCs can also give you loans, but they work a bit differently. Their loans are not linked with the repo rate directly, but they have their own internal rate called PLR, that is prime lending rate. So, even if the RBI reduces the repo rate, it does not guarantee you that the NBFC will also reduce their loan interest rate. This is the main reason why NBFC loans are usually costlier than the bank loans. But they are quicker in processing the loans and sometimes more flexible with the paperwork as well. That is the main reason why people go to NBFCs. So, what should you do in this case? If you are planning to take a new loan, go to a bank that is offering you a loan that is linked with the repo rate. If you already have a loan with a bank, ask your bank if it is linked with the repo rate or not. If the loan is not linked with the repo rate, ask your bank to shift it to the one that is linked with the repo rate. If you already have a loan, especially with the NBFC, then this is a very good time for you to switch your loan from NBFC to a bank. Yes, there is a one-time processing fee when you transfer your loan, but the benefits you get from the lower interest rate in the long run are totally worth it. And the next time when you hear that RBI has reduced the repo rate by 25 basis points, don't just scroll past it. Ask yourself whether it is helping you to save money. Because the RBI is doing their part, now it's your turn to check whether your bank is doing theirs. If you find this video informative, then hit the like button, share it with your friends, and follow us for more such informative videos.